Do you know what the most expensive mistake most people over 30 make? They think they still have time. They sit around waiting for the perfect moment to invest, while inflation devours their savings. And the global crises of this year, 2026, prove over and over again that job security is a 20th century myth. If you are still relying solely on a paycheck to maintain your lifestyle today, you aren't free. You are a hostage to circumstances. Listen to me closely, the market owes you nothing. It doesn't care about your hard work or your years of service. The only way to win this game is to stop working for money and force your money to work for you. And in today's context, with the volatility we're seeing in the tech sector and the massive rotation into value stocks, dividends aren't a boring option, they are your literal life raft. Today, we aren't talking about risky bets or the latest AI hype. Today, we are talking about building a fortress. I'm going to show you the 3 dividend ETFs that, with updated data for March 2026, are the heavy artillery pieces your portfolio needs right now. We are entering the 3rd month of 2026, and the landscape is interesting, to say the least. We're coming off of February where the energy sector and basic materials jumped nearly 20%. While big tech darlings are suffering significant discounts for someone your age, someone with responsibilities, perhaps a family, or dreams of an early exit, watching your net worth swing 5% in a single day isn't just stressful, it's unacceptable. That's why our focus this month is quality and real yield. We aren't just looking for companies that pay dividends, we are looking for structures that survive volatility. Let's dive into the first one, SCHD, the Schwab US Dividend Equity ETF. If this channel were a library, SCHD would be the first book everyone is required to read. As of March 2026, it remains the undisputed king for those seeking the perfect balance between capital appreciation and dividend growth. Why now? Because SCHD doesn't just pick companies that pay a lot, it picks companies with pristine balance sheets. Its methodology filters for companies that have consistently increased their dividends and possess robust cash flow. In a market where the smoke and mirrors are clearing, SCHD bets on reality. The current yield is sitting near 3.3%. That might not sound crazy, but remember, this is a dividend that grows at nearly double digits every year. Looking at the data for March 2026, the fund just completed its annual reconstitution. It has maintained strong positions in defensive sectors like healthcare and consumer staples, with names like Lockheed Martin and AbbVie leading the pack. The mentor's vision for this is simple. SCHD is for the investor who understands that wealth is a marathon, not a sprint. It won't make you rich tomorrow, but it will make you free the day after. If you want stability while the Nasdaq bleeds, this is your sanctuary. Moving to our second pillar, VYM, the Vanguard High Dividend Yield ETF. If SCHD is a scalpel, VYM is a Roman shield. This Vanguard ETF is massive, diversified, and designed for one thing: maximizing current income without sacrificing safety. What makes it special in March 2026? Unlike other funds that concentrate on only 100 companies, VYM holds over 500 positions. This is crucial right now with the sector rotation we are experiencing this quarter. You do not want to be exposed to a single industry collapsing. VYM gives you exposure to banks, energy, and old economy industrial companies that are back in the spotlight. We are seeing a yield of approximately 2.4% to 2.6%. Its top holdings include giants like JP Morgan Chase and ExxonMobil. With oil prices holding firm this year, the cash flow these companies are returning to shareholders is historic. I recommend VYM if you are the type of person who prefers to sleep soundly at night. It is the perfect foundation for a portfolio. It isn't exciting, but boring things are usually what make the most money in the long run. Let's take a necessary pause here. If you've watched this far, it's because you're no longer satisfied with just financially surviving. You've realized the system isn't going to take care of you in your old age. Here at Evolutive Productive, we don't just share stock tickers, we share a philosophy where productivity translates into freedom. If you value this perspective and want us to keep analyzing the market with this raw honesty, subscribe now and hit the bell icon. Don't do it for me, do it so the algorithm keeps showing you content that helps you evolve, rather than just wasting your time. And if this video is providing value, leave a thank you in the comments. It helps us keep growing together. Now, let's talk about our third pick, FDVV, the Fidelity High Dividend ETF. This is where we get strategic. While the previous two were defensive, FDVV is our offensive move for March 2026. Why is it different? Fidelity has a very particular way of selecting assets. Unlike Vanguard or Schwab, FDVV isn't afraid of technology. as long as that technology pays dividends. In this current stage of 2026, many software and semiconductor companies have matured and started distributing profits aggressively. It's the highest yield of the three today, hovering around 2.8% to 2.9%. Data shows that FDVV has significant exposure to sectors that are on sale this month, while others are fleeing the tech sector due to recent volatility. This ETF is taking the opportunity to buy high-quality companies at reasonable prices that continue to pay growing dividends. FDVV is for the investor who wants a bit more spice. It offers that growth capture that traditional dividend ETFs sometimes miss, while always keeping the anchor in the quarterly payout. It is the perfect bridge between yesterday and tomorrow. So, mentor, which one do I choose? The short answer is, you don't have to choose just one. Financial wisdom lies in the structure. Use SCHD as your dividend growth engine. This is what will make your income much larger 10 years from now. Use VYM as your safety anchor. It's the net that catches you if a specific sector hits a recession. And use FDVV to ensure you aren't left out of technological innovation while getting paid along the way. In March 2026, the market is giving us a golden opportunity. There is underlying fear, there is noise, there is politics. And in the middle of all that chaos, these companies continue to sell products, provide services, and most importantly, deposit money into their shareholders' accounts every 3 months. Dividend investing isn't a get-rich-quick scheme. It is a dignity strategy. It's ensuring that no matter what happens with the government, with your boss, or with the global economy, you have a source of income that does not depend on your physical presence. You are over 30, you aren't a kid testing his luck anymore. It is time to be the architect of your own freedom. Don't wait for April. Compound interest does not forgive indecision. If you want me to dive deeper into how to set up an automated portfolio so these dividends reinvest themselves without you lifting a finger, let me know in the comments. Remember, evolution isn't an option, it's a necessity. I'll see you in the next video from Evolutive Productive.